Welcome, Erkko Etula. You are the CEO and co-founder of Brooklyn Investment Group, and we're excited to have you here today.
Thank you for having me.
Our pleasure. You have become kind of an icon in the world of index investing, and I wonder if you can tell us a little bit about the Brooklyn Investment Group and the history and how you got where you are now.
Well, the story of Brooklyn Investment Group really, frankly, started about a decade ago. Really, I was at Goldman Sachs. I was at Goldman Sachs for over 10 years, running strategic and quant asset allocation research on the wealth management side of the business. So my client has always been the financial advisor, and I sort of found a calling in trying to figure out how to basically give you, the advisor, more time to spend with your clients, to grow your business. So what are the processes and tools that you need to succeed, right? And when you look at things from the perspective of the end client, typically they want personalization and tax efficiency in order to continue creating wealth, right? And in order to deliver personalization and tax efficiency at scale, you need some technology, right? So Brooklyn Investment Group was born out of basically the need of independent financial advisors to further grow their business while delivering that highly personalized, tax-efficient investment solution to their clients. So most concretely, I was always listening to the stories that the breakaway advisors told me after leaving Goldman Sachs, and what they were missing out there in the ecosystem outside of the Goldman Sachs world. And the one thing that kept coming back was this idea that why not just put all the investments in a single account? So thinking about your equities, your fixed income like municipal bonds, your ETFs, your mutual funds, in order to truly maximize the return after taxes and get rid of all these frictions, we should hold individual stocks. That's called direct indexing, rather than buying ETFs or mutual funds. We should hold individual bonds, again, things like municipal bond ladders, and we should do it all in a single unified solution, with things like daily after-tax reporting, so it's easy to track what's going on, right? And do that in an easy and cheap way. So I left Goldman Sachs in 2021 to co-found Brooklyn Investment Group to do just that. And a year and a half, 2 years after that, we partnered with Nuveen Asset Management to bring municipal bond capabilities onto the platform. And a couple of years later, Nuveen acquired us, lock, stock, and barrel. So here we are today in 2025.
Here you are, one of the most innovative young companies, paired with Nuveen starting in 1898, managing $1 trillion. How's that all working? It's interesting.
I think it's frankly beautiful and very effective to put together a firm from the 1800s and the firm from the 2020s, right? So combining the innovation and the ability to leverage the latest cloud-based technologies, for example, with the investment expertise, particularly in the less efficient asset classes like, say, municipal bonds, from the 1800s. So, and look, it's always been a cultural fit for us to work together from the very, very get-go. When we started working together in 2023, we found that we very much have a shared vision for the future of investing, which is really to provide an open architecture experience for you as the advisor to deliver the best investment solutions to the end client.
Yeah, we really do appreciate that because we look at our clients and our business as relationships under management. I think a lot of people think of assets under management, but by the way that you are simplifying life for clients and just being able to customize a portfolio, but then put a tax overlay on it, it's remarkable. If you think about direct indexing, and it's been around for a while, you've taken it to another level. Can you describe what your differentiator is? Starting wherever you want, because there are many differentiators, but love to hear more.
Yeah, so first of all, the term direct indexing, it's becoming a bit of a misnomer. Originally we started calling it direct indexing because you would basically start holding the individual stocks in an index rather than buying, say, an ETF or a mutual fund. So you're directly indexing to, say, the S&P 500, right? Now, but the reality is that you don't need to be tracking an index. It could also be, say, an active strategy, right? So rather than buying an ETF or mutual fund that tracks an active strategy, we can equally well buy a subset of those stocks in that active strategy.
So your
right?
approach can be customized to whatever that client is holding.
Correct.
As opposed to having very specific rules.
Correct. So, and then you can combine your indices and active models, and yeah, you can still get some exposure to, say, things like commodities and emerging markets using ETFs, for example. But the idea is that when you open up the ETF or the mutual fund wrapper and hold those underlying stocks, then you can not only get the additional personalization and reduction in fees because you're not paying for that wrapper, right?
Right.
But you can also do active tax loss harvesting, right? And what does that mean?
So differentiator number 2, because customization, and some companies, some of your competitors have very distinct rules about how much in an individual concentrated position can be in there, or they may have models that are required. In your case, you really can choose your own adventure.
That's right. That's a great way to put it. And whether it's the mix of asset classes in the asset allocation, whether it's an active or passive benchmark, you can really blend things the way your client desires. And frankly, what is your best investment advice to your end client? And then what we do is we implement that set of investments or strategies or allocation with tax management. So let me kind of take you a little bit back in time to the evolution of the various investment vehicles and tax efficient investing, right? So let's go all the way back to the early 1900s. Now, so a mutual fund was a revolution because it enabled investors to come together, pool their investments, and get broad market exposures like, S&P 500, like with very low transaction costs, right? So in the middle of the century, that was a big advancement, and Vanguard, John Bogle did a great job bringing that to the end investor. Now, fast forward to the 1990s, when the birth of the ETF basically said, like, look, well, mutual fund is great, but it's not very tax efficient because you get the distributions of the capital gains, for example.
Capital gains and ordinary income, typically a surprise in November or December. You really had no way to manage it. It just happened.
It just happens. All of a sudden, you get a capital gain. And frankly, a lot of the trading in that fund may have been before you even bought the fund, right? So that could sort of get socialized among everybody that holds a fund. So ETF was a great way to help basically absorb the capital gains distribution. So ETFs do this thing called the heartbeat trade, where they basically get rid of that capital gain. So for an ETF that is managed well, essentially there are no capital gains distributions out of that ETF. So that was a big improvement over the mutual fund. And then now let's go to the next level, which is basically saying, hey, well, you could actually do better than matching the pre-tax return of the investment vehicle. So let's think about, for example, S&P 500, right? So there's always some turnover and this and that. So with an ETF, you can pretty much match the pre-tax price return of the S&P 500 because there are no capital gains. But could you do better? Could you actually, on an after-tax basis, even beat the S&P 500? So that requires for you to be able to pass those realized capital losses to the investor.
And when did you start thinking about the importance of shorting, the importance of harvesting those tax losses?
So
that you get both a pre-tax bump and a post-tax bump.
Yeah, so let's think about the sequence. So the idea of tax loss harvesting in what I would call a long-only context, that's been around since the late 1990s. The first firm started doing that, and it really became popularized around 2010s and onwards, right? So that enables you to sort of for particularly young portfolios, it enables you to generate pretty meaningful tax losses, right? But what happens when portfolios have appreciated, right? So over time, stocks tend to appreciate, and that means that no matter how much volatility that you have in the market, you will not be able to harvest meaningful tax losses. So then we need some better tools. So what can you do to either resuscitate a portfolio that is very appreciated and is no longer generating those capital losses, or what would you do with someone who has a concentrated stock position and wants to diversify out of that into, say, something like the S&P 500 without paying capital gains, or an entrepreneur who sells their company this year and has a massive capital gains tax that they want to offset with capital losses. So what can you do there? So that's when we go to the kind of the next iteration, and I think this is the most sort of exciting iteration of basically the wealth management industry, I would say, over the past several decades, is the idea that you can also go long and short. So rather than just holding stocks and owning a portion of an index or blend of them long, you can build a long-short extension, right? So that's essentially saying, like, okay, you come with whatever you have, and then we buy additional stocks, both long and short, to then do two things. So one is
traditional indexing, direct indexing, was long only until about when? When did that change take place?
Yeah, so that change started taking place around 2019, 2020.
Okay.
And the first sort of strategies came to the market just a few years ago.
Yeah.
So this is a very recent development, which is basically putting together two old pieces, really, when you think about it. Like, one is the tax loss harvesting, so the tax management using individual position, which has existed really since the late 1990s, right, early 2000s. And then the other piece is long-short investing. So the first hedged fund, as they called it back in the 70s, was actually a 130-30 vehicle. So when someone said, like, well, it's great to hold the market risk, but let's create some additional return by borrowing something extra on the margin, so buying extra 30% in long stocks and then shorting the same 30% to basically eliminate the market risk and potentially any other factor risks as well from the portfolio. So now when you put those two pieces together, that's very powerful for two reasons. So reason number one is that now all of a sudden you expanded the size of the portfolio, going from 100% to 160%, for example, so 30 long, 30 short, right? So now all of a sudden you have more volume in the portfolio to do loss harvesting and you've created new cost bases, as we call it, to
Well
be able to do
explained.
that.
I love that.
Right?
Yes.
And then the second reason is that now you have those short positions, right? So markets, as we know, tend to drift up over time. And the reason why the traditional tax loss harvesting tends to start failing after a few years is because, again, the market values have gone away from the cost basis, right? So now with the shorts, they keep generating losses as markets tend to rally. So a long short tax loss harvesting strategy can, in principle, go on indefinitely.
So one, we have customization. Two, we have long short. So now with the short, not only can we capture more or do more tax loss harvesting, but also we can even capture returns when the market experiences downside, right?
Yeah, that's right. So the beauty of a long short approach is that you're able to more consistently generate losses in both up and down markets, right? And then you can also, through stock selection in the long short, you can then also generate additional returns.
Additional return.
Right.
Yeah, great. So now the third iteration is really the frequency with which you do the selling, the long short rebalancing
Yep.
of the portfolio.
Yep.
And that distinguishes you as well, right?
Yeah, so markets are volatile if you look at the broad market, but if you zoom in and look at the individual stocks, there's a whole lot of movement going on every day. And it is that movement in the individual stocks that we can really harness to our benefit using the long short tax loss harvesting. Right?
And up to now, the analytics that a lot of firms used were doing the tax loss harvesting, but they weren't doing it on a daily basis,
Yeah.
right?
So
Sometimes only monthly, sometimes only quarterly.
exactly.
And so it's really difficult to capture that return if you're not increasing frequency.
Yeah, and that's right. So we're monitoring every portfolio daily, right? And
Yep.
and we're basically interrogating every portfolio for reasons to trade, potential reasons to trade, right? And so in the long short portfolios that we manage, we found that it is desirable to rebalance those portfolios at least weekly. Right.
Okay.
And
At least weekly.
Yeah, and sometimes we do it even more frequently. Like, for example, this past April, when we had the Trump tariff drawdown, right? So during the first 2 weeks of April, we on average rebalanced our long short portfolios 3 times during just the first 2 weeks. So and that helped us generate tremendous amount of value for our clients.
It was substantial, and it was one of many things that directed us to you. So what you're doing really is transformational, and so it makes us excited that we can add that kind of value to clients.
Well, I got to tell you that this is probably the most exciting development in the wealth management space since, gosh, I don't know, maybe the invention of the ETF, right?
I agree, and it was amazing when I first heard your presentation in Phoenix quite a while back. I just thought everybody ought to know about the Brooklyn Investment Group, so I'm really excited about that. You named the company the Brooklyn Investment Group, but that accent isn't from Brooklyn. Where do you hail from?
Originally from Finland.
Finland.
That's right. I left Finland when I was 16 to go to high school in the UK, and then I ended up here in the US for college. And I always tell people that I'm here by choice.
Well, we're glad you're here. And then when you came for college, you weren't fooling around. I mean, you got your MS from MIT, and you got your PhD from Harvard. How did that academic training affect what you're doing today?
I think both MIT and Harvard, particularly MIT, instills in you an understanding that ultimately you know very little, and you get to approach the world with a great deal of humility, right? And so combining that with sort of the intellectual curiosity that I've always had, I've always just wanted to make things more efficient, right? Without sacrificing on basically quality, right?
It's really interesting though, because there's a humility about that says that you're willing to look at things, from both sides, and willing to be wrong in order to get better. And I don't think people always think of those schools in that term. So it's really interesting that you would say that.
Yeah, and I would argue that in investing, you do need a great deal of humility because there's risk, and in order to generate return over any period of time, you have to take a risk, right? Mm-hmm. And you have to take risk in a managed way, right? Mm-hmm. And a lot of that is really just humility. The market is always right.
Right. You'll never be able to know everything or to know what to expect in the market. But you decided to limit risk both with the long short, so you can somewhat remain market neutral. And then you've initiated the use of AI. You're probably one of the most technologically advanced investment companies. Can you speak to that?
Yeah, and so in fact, Brooklyn Investment Group is the name of our investment advisor, but the name of the technology company is Brooklyn Artificial Intelligence.
Brooklyn AI.
That's correct.
Okay.
So we really founded the company as an AI company from the get-go. So most of our engineers, they come from an AI background. My co-founder, he developed one of the first language models way before the era of the GPT, and so when the GPT revolution really started, we knew how to apply AI to help in the operational elements of portfolio management and wealth management more generally, right? Mm-hmm. And so when you think about the job of a portfolio manager, managing thousands and thousands of portfolios, a lot of it is very operational and boils down to basically efficiently distilling information from the world around us, right? And so there are always limits to human attention, right? So there are only so many things that a human portfolio manager can pay attention to any given day. But AI can help us tremendously in basically interrogating the portfolios
the data
for reasons
gathering
to trade.
brain.
Exactly. Right. So the daily monitoring and making sure that there are no dogs that didn't bark, so to speak, right? AI can do a very good job with that. So what we basically developed is a way to use AI and enhance our ability to monitor portfolios, manage risk, and basically surface the relevant information to the portfolio manager. And ultimately, we're in the fiduciary business. It's the human portfolio manager is calling the shots at the end of the day. But again, why not aid that portfolio manager with some AI analysts in addition to the human analysts?
Yeah, and as you said, you have probably half engineers and half AI analysts on your team. Is that right?
Yeah, and
investment.
It's so quantitative. So it's interesting how
30 people at Brooklyn Investment Group, and how were they split up?
Yeah, so if you look across our team, I would say 2/3 of the team are software engineers or have software engineering background.
Okay.
But that overlaps with our quantitative investment team.
Makes sense.
So we have this interesting mixture of quants who are engineers and engineers who are quants, right? It is very hard to build an organization where those two groups of people live in harmony, right? And that was something we did from the very get-go. Again, quants, they always typically in an organization look down upon the engineers and vice versa for various different reasons that we can talk about another time. But what we managed to do is basically to bring those two groups together. And so that's why I'm always hesitant to say, like, how many quants or engineers do we have, because there's so much overlap. And the quant is really the investment side, systematic investing, creating the strategies, and the engineers are building the infrastructure, making sure everything scales in the cloud. But in our business, oftentimes they're one and the same thing.
You also served as a director of the Fed for a couple of years, right?
Yeah, so I was an economist at the New York Fed during the financial crisis. That was one of my
Thank you, an economist.
yeah,
Fed.
yeah.
Apologize.
And so that, frankly, again, talking about humility, right? So I got my PhD. In fact, I was working on my PhD in 2008,
Timely.
right before the collapse of Lehman Brothers, right, in September 2008. And my dissertation, it was interesting. I'm very thankful to many people, particularly Tobias Adrian. He's currently the financial counselor of the IMF, but he was at the Fed at the time, and we were thinking about what is driving basically risk appetite in the market, right? And basically, if you understand what drives risk appetite, then you know whether assets are probably cheap or expensive. So what are the expected returns going forward, right? And we were able to trace down markets' risk appetite to the amount of leverage that large financial institutions like broker-dealers were taking. Turns out that fluctuates a whole lot. So this was before the Lehman event. So then when Lehman went bust, so basically what happened was that the balance sheets of these primary dealers, large broker dealers, Goldman Sachs, others, they basically contracted. So the risk appetite of the financial sector went down very rapidly, right? Which then obviously led to a lot of sales of financial assets, right? So that dynamic between the leverage of the financial system, the risk appetite that is associated with, and then the asset prices, that's what I was doing before the financial crisis, and then obviously at the Fed, and then I joined Goldman in 2010.
So investment background, AI background, economic background. When did you know, I mean, at age 10 or age 16, when did you know what you really wanted to do? And how, did you ever imagine you'd be doing what you're doing now?
I think of sort of career building much as sort of process of elimination in a way, right? So when you're young, you really don't know much at all, and that's actually great because you keep a lot of optionality open, right? And then as you sort of learn about more things and what your interests are, then you kind of like ruling out certain things, and you kind of gradually finding your path.
So remaining intellectually curious and being willing to even look at parallel tracks at the same time.
Absolutely.
You had, for the type of diversity in the work you do, you had to be, really left brain, right brain, and looking at different tracks all the time. It's interesting.
Yeah, but I've also had great mentors throughout.
Okay.
So at MIT, for example, I was very fortunate to get a job as the research assistant of Paul Samuelson, the first American Nobel laureate in economics, right?
Wow.
And so, so that was one of the sort of critical moments in my life. I was an undergrad at MIT. I got to work with, one of the greatest economists, if not the greatest economist of the 20th century, right? And so he taught me a lot of things about how to really think about the world in a structured way, and how you should always be able to trace whatever it is that you're doing, no matter how complex, to the very first principles. So as you know, Paul Samuelson, he basically took the economics of the early 1900s that was largely prose and turned it into math, right? And so that kind of way to think about the world, where you can take concepts that may be unstructured and create
or
structure
seem
around them.
unrelated.
Correct. Exactly.
Entirely interesting. Yeah.
So
Well,
formative people like that,
So
they
mentors.
really played a great role, and Tobias Adrian at the IMF, and another phenomenal mentor to me.
So great life experiences with people in the industry too.
Correct.
Okay. Well, what you're doing is nothing short of revolutionary, and we've been really excited to work with you guys. And I think any young person watching this would look at your success and ask the question, is there anything at all that your younger self would tell you now, knowing what you know today?
It never hurts to know more math. It never hurts to know more statistics. Those are the things that, it's harder to develop that knowledge base later on in life because you just get so
Great
busy,
point.
right?
You
So
do.
those are sort of some of the fundamental elements, especially thinking about
Because it really does affect everyday life and
correct
every scenario that we look at.
exactly. So you can always do more in those areas, and that you won't regret it. Yeah,
That's great. Thank you. And always one last question for our audience. If there were a book or a movie that have inspired you in any way, what might it be?
Oh gosh, I like historical fiction.
Okay.
Eric Larson has some great books in that category, sort of light but yet somewhat related to the past.
Great. I had the opportunity to hear him speak recently, so yeah, very interesting. Well, we thank you for joining us in the Legacy Lounge, and good luck. You don't need the greeting, but or the inspiration, I think, because you're doing so well. But good luck, and we look forward to working with you.
Everybody needs luck. Thank you so much for having me.
Welcome back to the Legacy Lounge, Erkko.
Thank you for having me.
Yeah, so I wanted to explore direct indexing as a topic, and maybe we could start with how would you define direct indexing, and what has been the evolution of that concept?
So I'll say, to get things started, direct indexing is actually a bit of a misnomer, and I'll explain why in a little bit. But if you think about the evolution of investing for private clients specifically, let's go back to the early 1900s, right? So in the beginning, there were no such things as mutual funds, for example. So people would invest in individual stocks and form portfolios of those stocks. Then roll to the middle of the century when, Vanguard and John Bogle rolled out the first mutual funds. That really then made investing in the broader market easier and cheaper, right? So diversification, right? Now, but the mutual fund vehicle, it's not a very tax efficient vehicle. Right. Because it spits out the capital gains once a year, and that's not great for taxable investors. So now roll to the 1990s, and the invention of the ETF really revolutionized the tax efficiency of investing, because the ETF can get rid of those capital gains through what's called the heartbeat trade. Right, so in-kind redemptions and distributions. Now, the next iteration is now what I would call the technology-powered managed account. So with an ETF, the after-tax return will not be greater than the pre-tax return. Right. Because the ETF cannot distribute realized tax losses to the end investor. Now, what the managed account does is each client has their own account, but you should think about that as, much of the same way we think about an ETF wrapper. It's really just a wrapper, a holding place for those stocks and bonds and other things. And now what is great about that is that through active tax loss harvesting, so essentially selling off stocks that are trading below their cost basis, right? And replacing those with other stocks that mimic the same exposures. So, replacing the Coke that is down with a basket of securities that might include Pepsi and other things, right? That will help us track the market or whatever index we're tracking, while generating those additional tax losses, which then can help bring the after-tax return above the pre-tax return. So S&P could be up by 10% this year, but on an after-tax basis, you might actually be up even more, right? And now, why did I say that direct indexing is a bit of a misnomer? That's because you don't have to track an index. You could also track an active strategy, for example. So tax-managed active equities is also becoming a very attractive thing. Or you could combine indices and active models. So it's really more about direct investing. So in investing in the underlying stocks, investing in the underlying bonds, while doing that active tax management to help bring the after-tax return hopefully above the pre-tax return.
So how then do you generate the losses if the market continues to go up? That I imagine that's a challenge. And so how do you think about working through that challenge?
So what I was describing to you is sort of direct indexing 1.0, right? So only holding stocks long, right? Now, the latest evolution in direct indexing or direct investing is tax-advantaged long-short strategies. So now you basically grow the size of the portfolio. So instead of the portfolio size, say you invest $100, instead of the portfolio size being $100, you can actually borrow on the long side to go, say, $130, while then shorting, so selling short stocks worth another $30, right? So now you have a long-short extension that is neutral to the market, right? So when stocks go up, the short side is losing money, but that money is replaced by the long side making money. So again, the extension ideally does not change in value, but we can harvest losses on one of the two sides depending on which direction the market is going. And to answer your question, this is particularly great as markets generally tend to drift up. So a big critiques of the traditional direct indexing 1.0 is really the fact that over time, the market values of your stocks go so far above the cost basis that no matter how much volatility that you have, you cannot really do tax loss harvesting. Now with long-short tax loss harvesting, the short leg of the portfolio tends to keep generating those losses. So in principle, long-short tax-managed strategies can generate losses indefinitely.
So with that leverage obviously comes a little bit of risk. How do you balance that risk then in when you add leverage to a portfolio? And how do you think about that? How do you think about risk, I guess, in general?
Yeah. So in any sort of investment, there are different types or segments of risk, right? So the biggest risk for most investors is the market risk, right? So, and that's just holding long exposure to market. And frankly, when thinking about the market risk, that's where you have to calibrate the portfolio to the investor's risk aversion or risk tolerance, right? So maybe the appropriate benchmark is not 100% in equities. Maybe it's 60% in equities and 40% in cash or fixed income assets, right? Now, when you put the long-short overlay on top of that, you got to make sure that you're not inadvertently introducing those market-like risks in the portfolio, because you don't want to double down on those risks. So the overlay itself should be market neutral, so beta 0. So again, when market's going up or market's going down, the value of that overlay does not change, right? But then in our view, it should also be neutral to factors, like, for example, the value factor. You should not be persistently long value stocks and short growth stocks, for example, or quality or momentum or any of these other well-known investment styles, right? If you want to take those type of style risks, you should really embed them in the asset allocation to begin with, right? But But whenever you're adding something new to the portfolio, make sure that it's independent or orthogonal to the rest of the things you already have in the portfolio.
So that's great. So what you're saying is you really are thoughtful about those, isolating the risk that you want to manage. So in other words, you just want to manage that market risk and create pre and post-tax alpha. Is that kind of one way to think about it?
Yeah, so when you're creating that long-short overlay, you have to have some mechanism for stock selection. So some process that you're using to select which stocks to go long or which stocks to go short, right? And you also have to do that to create economic substance, because otherwise you're just creating that overlay for tax management purposes. And that may not be a great idea from the IRS's perspective, right? So when you're creating that long-short overlay, we as the investment manager, we have the ability to then seek to generate some outperformance also on a pre-tax basis. So we're using signals that can then potentially add additional return also on a pre-tax basis. And when you kind of think about these magnitudes here, so obviously just like in any investment strategy, risk management is paramount, right? But then the second most important thing in these strategies is tax management. And again, that can potentially generate significant value. We're talking about perhaps tens of percentage points of value to the end client. Now the pre-tax stock selection, we're talking about magnitudes of single percentage points of performance deviation from your benchmark. And then finally, the kind of the fee layer, what does this all cost to the end client? Now we're talking about tens of basis points, or 0 point something a percentage point. So that is the kind of the interesting kind of ordering of the importance of the things that we do in the long-short tax managed strategies.
And so when you increase the leverage, how does that impact sort of the tracking error? I guess the track relative to what you're trying to benchmark against. And so how does it impact the risk in terms of what are the risks that you start to see as you increase leverage?
Yeah, so increasing leverage. So now, assuming that you're not introducing any additional market risk or factor risk or anything else. So increase in leverage almost mechanically increases the tracking error, right? And so the more tracking error you take, basically the greater volatility you will have in your portfolio. And if you think about the simplest situation is basically if your benchmark is cash and you're running a pure long-short overlay, right? Say 30% long, 30% short benchmark to cash, then the tracking error is the same thing as the volatility of that thing, which should be then 1% to
and
2%.
What does that volatility tend to be at the 130 level relative to, let's say, a 200 100 level or versa? How does that change as you go up in terms of leverage?
Yeah, maybe let's put these numbers in the context of the market volatility,
Yeah,
right?
that's great.
So starting with tracking the S&P 500, we know that the equity market volatility is 15 to 20%, call it 20%, right? So when you put the 30-30 overlay on it, those types of strategies typically run with a tracking error of about 1.5 to 2%. So basically that means that your portfolio volatility is going from 15 to 20% to maybe 17 to 22%, right? Provided that this overlay is uncorrelated to the market, which is what we do by design. Now, so when you increase that leverage, so from 130-30 to maybe 250-150, so you can add quite a bit of leverage there if you'd like. That basically then takes the tracking error from that 1 to 2% neighborhood to maybe 8 to 9% neighborhood, right? So and so then again you kind of compare that to the risk of the market. So maybe your volatility goes from 15 to 20%, to 20 to 25 to 30%, right? And what is really interesting about this is that.
But at the same time, when you're doing that, you're getting extra pre and post-tax returns. So there's a reason for taking the risk. It's not just adding volatility. It's adding volatility to add.
Absolutely.
Right.
Absolutely. So the active management part associated with the stock selection, like I said, it's it's critical for these strategies because these are actively managed strategies. The objective is to generate both pre-tax outperformance as well as after-tax outperformance, right? So it is an additional source of return. If you think about breaking your investment portfolio into the factors that drive those portfolio returns, you have the market factor, you may have the interest rate factor, maybe you get some liquidity premium from alternatives, and then this is yet another uncorrelated source of return. So absolutely, that can be an important driver of return.
So, thinking about when you talked about the SMA or the separately managed account, because these are such unique situations for each client, how are you able to make these customizable and scalable? Because I think that's the challenge. Generally, when I think of scalable, I think that customization starts to decline, not increase. So how can you sort of solve for that?
Yeah, so I think this is where you need to take the asset manager's hat off and put the engineer's hat on, right? So we were fortunate enough to build our platform starting with the 2021 sort of cloud-based technology, right? So and what does the cloud-based technology do for us? Well, when you go from the management of funds, where basically you put all of the investors' eggs in single basket and you watch that very closely, to a managed accounts world where basically you put each egg in its own basket and then let those things do whatever they need to do, you gotta start with a scalable platform, and that requires basically software engineering. So if you think about Brooklyn Artificial Intelligence, that is the mothership of Brooklyn Investment Group, we are a technology and artificial intelligence company. And to be able to monitor and risk manage those individual accounts at scale, that's where you not only need the engineering skill to be able to scale that, but you also need some additional monitoring capabilities, which AI is particularly well suited to deliver.
So thinking about that from a client experience perspective, I mean, this is very much it sounds like it's designed to help the advisor in some sense. And so can you kind of talk to that about how you were thinking about building it for the advisor and where you see that going, and kind of where's the path forward in terms of that client experience?
Yeah, so and again, I worked with financial advisors my whole career, so I always tell people that if you want to know how to fish, you have to think like a fish, right? So I often want to put myself in your seat, and frankly, we designed a lot of the advisor experience in collaboration with some of the more prominent financial advisors in the country. So ultimately, what you need is to spend more time with your clients. You got to be able to listen to your client and incorporate those preferences in each portfolio, whether those are tax preferences or other types of preferences. Now, and how do you scale that? Well, you should be able to kind of put those portfolios in an autopilot and not get tied up in the operational elements of portfolio management, right? And so when we ask financial advisors, like, what do you want? Like, what do you need? Typically the answer is everything. And frankly, that is the right answer, because you're serving some of the wealthiest individuals and families in the world, and the world is their oyster. So now it's our job to provide you with a platform that helps you provide that advice as well as to scale your business. So if you think about our journey, so we started by building a scalable managed accounts platform for equities combined with fixed income. So Nuveen, the partnership that we've had with them since the 2023 and the acquisition that they made this summer, we've been on that journey for a while. And so the next iteration for us was the addition of the long-short capabilities, right? And those capabilities we launched about a year ago, so summer of 2024. And then we're continuing to add investment capabilities to this platform, because again, like What do you want? You want everything, right? So we got to make sure that we're thoughtfully adding the types of capabilities that basically helps you deliver that whole portfolio solution to the end client without getting bogged down in the operational elements of portfolio management. So next up for us are options overlays. They're alternatives. So stay tuned for all of those updates in the months to come.
Okay, great. Now that's really thoughtful, because one of the things we've been trying to understand is kind of what the next step is, and in one sense, it's the breadth of the asset types that you can use, which is really helpful. But it's also maybe speak to the investment process itself, and what enhancements you're considering on that side, or improvements or additions that you've been sort of exploring on that side as well.
Yeah, so we're constantly looking for additional sources of alpha, or basically stock selection alpha, for our long short processes, and that is an ongoing journey. And my perspective is that the world of active long only management and the long short management are really coming together. So the same way that asset managers tend to have their long only active equity models that they deliver the various platforms, we can frankly take those models and create long short versions of them, right? So ultimately different investors prefer different types of stock selection depending on their appetite for risk and return, and it's our job to deliver them. So we don't take a stance that our stock selection process is then the best of the world and that's the only thing you should be using, but we are open to implementing strategies for others as well, and frankly we do that. Something that I didn't mention is that Brooklyn also has a significant technology business where we are renting or selling our platform as a SaaS solution to other asset managers, right? So that is an important element where basically our technology is powering increasingly greater and greater parts of the industry. And again, I tend to think about Brooklyn really as a more of an industry utility when it comes to investing.
So yeah, from that perspective, I mean, in some sense, you want it to be the overlay for any taxable portfolio. Is that kind of the end goal of what the Brooklyn story will look like?
Absolutely. Yeah. So pick any portfolio, any asset mix, any instrument mix. That portfolio should be tax managed. So the wrapper, that is the technology powered managed account, you should be able to put any investment in it and put the tax management and the personalization layer that operates in an automated fashion on top of it.
So one aspect of this too is the idea of the person versus the machine, and AI versus technology. And can you kind of talk about how you think about that in terms of your process?
So the way to think about the man and the machine is by thinking about the fiduciary risk. So ultimately, we are the asset manager, we're the portfolio manager, and there's always a human being at the end of the portfolio management funnel calling the shots, right? So, but that human portfolio manager, to do a good job, should be leveraging the help of his or her analysts, as well as potentially some AI analysts that are basically interrogating each portfolio on a daily basis for potential reasons to trade, rebalance, manage risk, harvest losses. But again, it's very important that at the end of the funnel, you're making a fiduciary decision as the portfolio manager, but you should definitely use AI and technology to help you make better decisions.
Yeah, thank you. That's great. Erkko, I think we're at time, but thank you so much for your time today. This was a fascinating discussion, and look forward to speaking again.
Really great to be here. Thank you so much for having me.